Hi everyone, here we are again. Like today I'm going to talk more on the personal side. I'm going to talk about individual returns, and I'm going to talk about some of the changes of 2018. So as you all know, you probably already had a change in your paycheck, getting a little bit more money. So what is happening with that? There's a lot of questions, there's a lot in the news, there's a lot of stuff going on. So we are really, this year is going to be a very big transitional year for a lot of people, because back to like probably, I don't remember when the table started, but maybe 1986, for the longest time we've had this deduction in our tax return called a dependent. So for every child or aging parent or an older child that's disabled, we would get a deduction from our taxable income, about depending on what year we were in the $3,000 to $4,000 level. Meaning you had 3 kids at $4,000, you were going to get a deduction of $12,000. We don't have that anymore. So when we used to, if you remember, every year we would fill out this W-4 that would say, are you single? Are you married? Are you head of household? What are you? And how many dependents do you have? That doesn't matter anymore. Now what matters now is, what they've said is, guess what? We're not going to have dependents anymore as a deduction. But what they did give is that before, your itemized deduction, if you were single, was $6,350. Now if you're single, the standard deduction is $12,000. So they gave us a big change in that. $9,350 for head of household, $18,000. $12,700 used to be the number for married joint, now it's $24,000. What does that do? What they've done is, instead of you having, there's people that they don't own a home, or they own their home and there's no mortgage interest, so they could never itemize, and then they would just get the standard. Well, that standard deduction has been almost doubled for the years 2018, I think, till like 2026. Unless it's continued. But we now don't have that 4,000. So how can, for the most part, they're hoping to catch and benefit everyone. But there's the example, for example, of someone that had a house and was itemizing and had a big mortgage and big taxes and had 7 kids. That person, it's not good for them, because now 7 times 4 was 28. You no longer have that. So you're going to have your itemized deductions, but you've lost this 28. So that's important. Now, what have they done to kind of help us with that? Is that before, if you recall, if you had a child that was older than 17, or a dependent such as a parent that you were helping, an elderly parent, you didn't get any kind of child or any kind of credit for that. You would get the dependent, but there was no credit. Now what they're doing is they're going to give us a credit. What's happened with the new tax law is that there's going to be a credit of $500 for kids that are older than 17, and for any dependent that you have that is an elderly parent or an older person that's disabled, that is your dependent, that is going to be on your tax return. So that's really important. That's new, and it's helpful because that's going to give a little relief for losing the dependents. Now we're going to have, going back to taxable income, there are going to be 7 rates. You can call the office, you can look those up. We have them, but there's 7 rates. As far as Social Security and Medicare, it's still going to be the same, 6.2%. And they changed the limit a little bit on that. It's gone up to 128.4. So after 128.4, you no longer contribute the 6.2% of Social Security. And there's no limit on the 1.45. That continues to be the same. Now, what else has changed that's nice is that the child tax credit, which is for all the kids, your dependents that are under 17, that used to be $1,000. That's going to be $2,000 per child. So anyone that has a dependent, now this is very key. It has to be your dependent. It cannot be, if you're separated or head of household, and the child is on the other spouses, you're not going to get that child tax credit. That child tax credit goes with that child under 17. And that went up from $1,000 to $2,000. In the past, that credit was not refundable, meaning, and now let's make the distinction between credit and deduction. A deduction is an item that gets deducted before you come up to taxable income. A credit is, I owe $3,000, it's a direct. I owe $3,000 in taxes, and I have one child, and they're gonna give me a $2,000 credit, so now I only owe $1,000. So it's a direct dollar for dollar tax dollar. Now, what happens with that, there is a limitation. The limitation is that they'll only, if you, let's say, for example, if you owe $1,800, if you owe $1,000 in taxes and you have a $2,000 credit, they're not going to give you a full, they're only going to give you back money. They're actually going to give you money back from this credit, but up to $1,400. Not the full two, but up to $1,400. So it's a refundable tax credit. Now, of course, there's limitations. It's capped. If a married couple, I believe if you make more than $400,000, there's going to be a phase-out period. And also, it's capped at 15% of your earned income. So it all depends, again, on where you fall in the tax tables and where the caps are set. Definitely, if you want to talk about it and see where you're at, what we're doing now this tax season, when we meet with our clients to finalize their personal return, we are doing a little analysis of what the impact is for 18. Because remember, our withholding and our paychecks are being done based on a tax, on rates, on tax rates that are being calculated. So we want to make sure too that how much we're looking at our clients and seeing how much they're being deducted, because we don't want to see you where you're used to getting a refund, that now because you're not having enough being deducted that you may not get a refund. Highly unlikely, but it could happen. So we are going to look at every client and kind of do an analysis of where we think that you're going to be at and make recommendations based on that, so that you end up either, if you're there's different types of clients. There's clients that they use the amount that they withhold so they can get a big refund at the end, and they use that for vacation or for whatever they have planned. And there's other clients that say, no, it's my money. I want to just send in whatever it is that I owe and not more. And there's other, so wherever you're at, wherever your structure is, wherever you like to be at, we're going to analyze it to try and keep you like that, even with all the big changes that have come about with the new taxes. Now, in another, I want to mention that the child dependent care credit remains the same. It was not touched. What that is, you probably know already if you get it, is that if both of you work and you have after school care, or if you have summer camps that are paid so that you and your husband you and your spouse can both work, then there's a credit that you get for that. And that's still the same. There was nothing that was changed on that. So we're going to talk a little bit more, about personal taxes in another. We're going to continue to talk about all the changes, because there are a lot of changes, and I don't want to talk for an hour or anything on that. I don't want to bore you with this stuff, but just give you information. Thank you so much for watching. Please remember, if you liked our video, to go ahead and subscribe, because that's the only way that we can send you information and keep you updated. Call us if you need us. And we will be putting another video soon. Thank you so much.